Hello everyone. This is the second video on chapter 9, and in this video I'm going to discuss the second learning objective of this chapter, analyzing a project's cash flow. Look, the first thing we need when we begin evaluating a proposed investment is a set of pro forma or projected financial statements. Given these, we can develop the projected cash flows from the project. Once we have the cash flows, we can estimate the value of the project using the techniques we described in the previous chapter, for example, the PV and IRR. Okay, so let's first of all understand the projected or pro forma statements. So pro forma financial statements are a convenient and easily understood means of summarizing much of the relevant information for a project. To prepare these statements, we will need estimates of quantities such as unit sales, selling price, variable costs, fixed costs. We will also need to know the total investment required, including investment in non-current assets and net working capital. Okay. Once we have those information, we can prepare a pro forma financial statements. And from this the pro forma financial statements, then we can estimate the projected cash flows, and those projected cash flows will be used to find out the value of a project and to decide that whether the project will be accepted or rejected. Okay, so we are familiar with these equations. We have learned them earlier. So just very quickly reminding again that project cash flow should be operating cash flows minus change in net working capital and minus capital spending. And how do we calculate operating cash flow? From a projected income statement, we can calculate operating cash flow, which is EBIT plus depreciation and minus taxes. Okay, and when there is no interest expense, we will have operating cash flow can be calculated as net income plus depreciation. Okay. So look at this example very quickly. So we have these estimated figures or estimated amounts to prepare an estimated or projected financial statement. So you can see we have estimated sales, sale price, cost, estimated life, fixed costs, initial equipment costs, which is the initial investment in non-current asset, investment in net working capital. That's also initial investment, but that's in working capital and tax rate. So once we have those estimates, we can, and cost of capital is 20%. Once we have these estimates, we can prepare a pro forma profit and loss statement. Okay, so you can see we have revenues, so number of units multiplied by selling price per unit, if you remember. So our estimated sale was 50,000 unit and sale price per unit is 4. So that's our revenue. And variable cost, once again, a number of units sold multiplied by the cost per unit. Again, so if you remember, this is our variable cost per unit. So that's our variable cost minus the variable costs are deducted from revenues. So we get we get gross profit, then we deduct fixed cost. That was also given in the previous slide. We also deduct depreciation. Now, how do we calculate depreciation? You remember our investment in fixed asset was $90,000 and it will be depreciated over 3 years. So we divide it by 3. So yearly depreciation will be 30,000. So depreciation. So from gross profit, we deduct fixed costs and depreciation. We get earning before interest and taxes, and then we deduct tax, which is 30% of EBIT, and we get profit for the period. So that is our projected or pro forma profit and loss statement, okay, based on our estimates. And then we can proceed in estimating the cash flows. So just a very quick look at our initial investment. So look, our initial investment is the investment in net working capital and investment in non-current asset, as I was telling you. So that's our total investment, or that our initial investment. Now look, this is how a book value of the fixed asset will decline. So our initial investment was 90,000. So at the end of the year, it is 60,000 after deducting depreciation. Then again, after deducting depreciation, 30,000 at the end of the project life, this fixed asset doesn't have any remaining book value. Okay, so book value or the accounting value becomes 0. But keeping in mind that this is the book value, not the market value. Okay, so the asset still might have some value left in the market. However, the book value is 0 because the entire book value or the historical cost was depreciated. Okay, and I was telling you earlier that net working capital is an initial investment when we start the project, and that should be recovered at the end of the project. So you will see this soon. Now, you remember the equation we have seen: operating cash flow equals to EBIT plus depreciation minus taxes. So these are the figures coming from the pro forma profit and loss. So this is our EBIT plus depreciation. I think you understand that why we add depreciation, because to calculate the profit, we deducted depreciation as it's an expense. But since it's a non-cash expense, we are calculating cash flows, operating cash flows. So we add back depreciation and we deduct taxes. So that is our operating cash flow, okay, each year over the life of the project. So you see, this is our operating cash flow in year 1, operating cash flow in year 2. In the last year, we have this operating cash flow, and as I was telling you earlier, that net working capital is a cash outlay at the initial time, initial investment, but that is recovered when the project is terminated, because the inventories will be sold out, cash will be collected, and so on. Okay, so that's the projected cash inflows in the third year. So these are essentially the cash flows from the project. Okay, so initial investment and project cash inflows, and we calculate our NPV. We already know how we calculate NPV. We have seen it in the last chapter. So we find out the present value of the cash inflows, deduct the initial investment, and our NPV is 13,428. Okay, and our IRR is 27.2%. I think you remember the decision rule. If NPV is positive, it means that it is adding value to the company. In this case, the NPV is positive, so we should accept the project. With regard to IRR, we accept a project if IRR is greater than the cost of capital. So you remember in one of the previous slides, we have seen that the cost of capital is 20%, and IRR, that means the rate of return generated by this project, is 27%. So obviously, its rate of return exceeds its cost of capital. So that also indicates that it's a value-adding project. So based on both NPV and IRR, the project should be accepted. Now, the tax shield approach, a useful variation on the basic definition of operating cash flow that we have seen earlier. A useful variation is the tax shield approach, right? So the tax shield approach is, you can see, the tax shield approach is defined as this. So operating cash flow equal to sales minus cost into 1 minus tax rate plus depreciation into tax rate. Okay, so this approach views operating cash flow as having 2 components. Okay, so first part is what the project cash flow would be if there is no depreciation. So this is the part I'm talking about. So that's the project cash flow if there is no depreciation. And the second part is the tax allowable depreciation deduction multiplied by the tax rate. Okay, depreciation multiplied by the tax rate. So this is called the depreciation tax shield. Okay, we know that depreciation is a non-cash expense. the only cash flow effect of deducting depreciation is to reduce our taxes, right? So we deduct depreciation, so our taxable income decreases, so is our taxes. Okay, and that's why we first of all deduct depreciation and then we add back, because we want to get this tax advantage, because that is a benefit to us. Okay. At the current, for example, 30% full company tax rate for Australian company that are not eligible for lower tax rate, every dollar in depreciation expense saves us 30 cents in taxes. Okay, so 30% is your tax. So if you pay $1 depreciation, that saves 30 cents in taxes. Okay, so for example, in this case, we had a depreciation of $30,000. So which means, so $30,000 and 30% is the tax rate. So it will save us $9,000 in taxes. Okay, so the tax shield approach will always give the same answer as our basic approach that we have seen in the previous slide. So you might wonder why we bother. The answer is that it is sometimes a little simpler to use, particularly for projects that involve cost cut. Okay, so either approach you use provide you the same result. So either one you can choose. Okay. Okay, now a couple of more points on net working capital. So Australian accounting standard requires that the profit and loss statement records the revenue when the sales incur, when the sales is made, not when the cash is received. Okay. Similarly, the cost of sales should also be recorded when the cost incur, not when it's actually paid. We have learned this. We have learned these points earlier, and also we have to buy inventories to support sales, although we haven't collected cash. Okay, so all these points have impact on our net working capital. Let's take a closer look at some aspects of project cash flow, in particular net working capital and depreciation in more detail. Okay. So if you recall, in chapter 2, we learned that accounting depreciation is a non-cash expense. We also discussed it in the previous slide. So as a result, depreciation has cash flow consequences only because it influences tax that I mentioned a few moments back. The way that depreciation is computed for tax purpose is that that's relevant method for capital investment decision. And not surprisingly, the procedure are governed by tax law. Okay, so let's learn some specifics of the depreciation system in Australia by the Income Tax Assessment Act 1936 and 1997. Both tax departments, I mean, in Australia and also in New Zealand, allow two ways of depreciating a farm's asset. One is a prime cost, which is the straight line method, or a diminishing value method. Okay, the prime cost method writes off a fixed percentage of original cost per year until the book value is 0. Okay, and the diminishing value method writes off a fixed percentage of tax book value of the asset per year. Diminishing value rates are normally twice the straight line rates. Okay, so these are the 2 points I just mentioned: prime costs and diminishing value method. Now, after tax salvage value, so when a project is terminated, the fixed asset of the project doesn't necessarily have a 0 value. Sometimes we are able to sell it with a value. Okay. Now, how that will cash flow depends on the relationship between the sale price and the book value of the asset. Okay. So if the sale price is different than the book value, then there is an tax effect. Okay. Now look, that book value is initial cost minus accumulated depreciation. So which means that, for example, if your initial cost is $100,000, and if you have your accumulated depreciation is 100,000, so it doesn't have any book value left. So it has a zero book value. Now, if the asset's market value is also zero, for example, so there is no tax effect. However, let's say although book value is zero, but you are able to sell the asset as $1,000, then it has a tax effect. Okay, so what is the tax effect? So this is after tax salvage value. So salvage minus salvage minus book value, which is the difference, into tax. Okay, so that will bring you a tax liability or a tax savings, and then you calculate net salvage cash flow. Okay, I will show you an example. So SP is the selling price and book value, and the others are corporate tax rate. Okay, so look at this example. It essentially covers 2 points that we have discussed. One is the depreciation methods, prime cost and diminishing value, and another is the salvage value. Okay, so look, an asset has a depreciation, I mean, a straight line depreciation of $1,500 every year. So the initial cost of the asset is $12,000. Okay, and it will be depreciated over 8 years. So as it has an initial value of 12,000 depreciated over 8 years, so if you divide 12,000 by 8, you get 1,500. So that's your straight line depreciation, and your book value declines every year by the amount of depreciation. And you can see that the end of the asset's life, the book value becomes zero. Okay, so this is how we calculate depreciation using the prime cost method. Okay, on the other hand, the diminishing value method, you have this certain percentages. Okay, you can find these percentages in the textbook. You have certain percentages, and using these percentages, the depreciation is charged every year. Okay, and you can see that in the initial year, the higher depreciation is charged compared to the straight line, and in the later years, lower depreciation is charged. Okay. Okay, now the implication of this prime cost and depreciable and diminishing value method on the firm's value and the firm's profitability is not the scope of our discussion here. Okay, that's why we are not going to in that discussion. Now let's see the example of salvage value. So let's say that the asset is sold at the end of year 5 for $5,100. Okay, now look at the end of year 5. The book value of the asset is 4,500. Okay, so book value is 4,500. It is sold at 5,100. That means it is sold over the book value. That's why you need to pay tax on this capital gain. Okay, the difference between the selling price and the book value is called capital gain, and you need to pay a tax on that. And the difference between these two multiplied by the tax rate, that is your tax liability that you have to pay. Okay, so that is called capital gain tax. Okay, and your after-tax salvage value will be this 5,100. That is your selling price minus tax. So that is your after-tax salvage value. On the other hand, if you sell it after second year, so after second year, you can see that its book value is 9,000, but if you sell it at 4,600, so your sell price is less than your book value. So which means that you do not have a capital gain, you have a capital loss. Okay, and that will not bring you a tax liability, rather that will bring you a tax saving since you are having loss. And as this loss is adjusted with your profit, that will reduce your taxes. Okay, and once again, multiplied by the tax rate. So that's your tax savings. Okay, and how much is your after-tax salvage value, which should be this 4,500 last tax savings, because that reduces your tax plus tax savings. So that will be your after-tax salvage value. Okay, so at a glance, this is the main information that you have. So you can see this background information that we have seen. So you have variable cost, fixed cost, sale price, tax rate, investment in net working capital, and your investment in fixed asset, salvage value. Then this is your depreciation calculation. Okay, so depreciation calculation is, you can see your equipment cost is 800,000, and it's depreciated 15% every year. So this is your depreciation, and then this is your book value. And salvage value is, you can see that at the end of the asset's life, there is no book value left. However, salvage value is 1,600. Okay, so you have to, that's entire 1,600, around 60,000 is your capital gain. So you pay taxes. So that's your net salvage value minus taxes. Okay. And your investment in net working capital. So your net working capital should be 15% of your sales. Okay. And an initial net working capital investment is 20,000. So that's your 20,000. And these are your net working capital requirement every year. Okay. So this is how depreciation is calculated. We already know that. We have seen it previously. And this is how the cash flow is calculated associated with the net working capital. Look, our initial net working capital investment requirement was 20,000. So that's the cash outflow. The second year, for the first year, when you are actually in operation, a net working capital requirement is 15% of sales. Okay, so that should be your net working capital. But you have already invested 20,000 in first year. So the remaining is your in cash outflow in first year. Then next year, your requirement is 90,000. So you already have 34,000 invested. So remaining is your cash outflow. This is how you calculate. However, when you come in year 4, look that your requirement is 107,250, right? And you will see that you have already invested more than that. And that's why you recover some of your working capital investment. Okay. So for the rest of the project's life, you have cash inflow coming back because you don't need that amount of net working capital anymore. Okay, so this cash flow will come into your project cash flow evaluation. Okay, so that's your projected cash flow. So if this is your EBIT, deduct depreciation, we already know all these numbers. Then we have taxes, we have operating cash flow. The net working capital is initial working capital investment, and these are the cash flow implication that we have seen just in the previous slide. Then this is our net working capital, our initial investment, okay, and after tax salvage value. So salvage value that comes at the end of your project. So your operating cash flow, change in net working capital, your capital spending. So that's your total project cash flow. You discount them, okay? And if you find the net present value is it is 85,000, internal rate of return is 17.85%, and project cash flow is 4.08. Okay, so we already know the accept reject decision for a project, and we know that whether this project should be accepted or rejected, right? We have discussed these points already. Okay, so just to remind the net present value is positive, that this project should definitely be accepted. And if you think about the required rate of return, our required rate of return is 15%, you can see, and here our IRR is 17.85%. So since IRR is higher than the required rate of return or the cost of capital, the project should be accepted. Okay, so that's the end of our discussion on project cash flows, analysis of project cash flows. So in the next video, we will continue discussing the NPV estimates associated with project cash flows. Thank you very much.